As the Wall Street saying goes, tide lifts all boats. Powerful and broad rally, and worldwide rally for that matter, pushes indices to new records. We will look at a trade example, Ford. I personally opened this trade a few weeks ago. Congrats to subscribers, but man, what a ride. Dollar is still somewhat indecisive, although its tendency is towards bullish, but the way gold miners are acting, and to a lesser extent gold and silver, is there something that perhaps dollar is not showing? We will try to decipher that. And we will briefly look at crude oil, which is continuing down, and it could enter a new downtrend. All this and more in today's edition of MasterChartsTrading.com. Market recap for Friday, May 29, 2026. As always, don't forget to hit the like button, share this video, make a comment, put a thumbs up in the comment section. This will tell the YouTube algorithm that this is a worthwhile video and it should be shared with others. Thank you for all the comments, thank you for all the thumbs up. I really appreciate it. This is what keeps this channel going. Thank you again. Please keep them coming. If you're a subscriber, stay tuned. We'll be covering quite a large section of stocks, ETFs, large cap stocks, as well as some of the lesser known names, such as new additions this week are Iovance Bio, Neogenomics, and Teladoc Health, as well as Tronox Holdings and WillScot Holdings. So quite a bit of new additions. Again, stay tuned. Throughout the presentation, I'll be using my proprietary MasterChartsTrading.com price action indicators. You can see them on this chart. There's green, blue, red, and yellow lines, which you can have on your chart of TradingView.com. All you have to do is sign up for TradingView.com for free. Come back to my site, MasterChartsTrading, sign up, and I will open the door for you. So stay tuned until the end, and I will explain how to do all of that. Alright, let's look at S&P 500. As always, we always open with S&P 500. Today, yet again, Friday, we saw yet another record high, and we basically saw record highs throughout the week. Now, let's look at this from a point of view of weekly charts and see if there is anything that stands out. And indeed, there is a standout small gap. So there it is. You can see a gap between between Friday last week and Monday this week. So this is it's a partial gap, because you can see that it was already partially. It was not, it's not a completely unfilled gap, so there is a small amount of gap. So how important that is, difficult to say, but certainly this is a very powerful rally. You can see how we had 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks up in a row. Doesn't seem like it wants to slow down. So strong rally, as they say, tide lifts all boats. So many stocks individually are going higher, and of course that is pushing indices to new records. Is this the end of a rally? There is no way to tell. If you stay tuned, or if you're a subscriber, I'll be covering some of the market breadth indicators, and some of those market breadth indicators are not even terribly overbought, so we could see another push towards new records next week. But there are some also indications that we might be finally becoming a little too hot, and that is characterized by the number of puts, the number of people who are selling, versus the number of calls, or rather the number of bullish bets and bearish bets. Puts are bearish bets, calls are bullish bets, and there's just so many calls right now that pretty much, as I keep saying, everybody and your grandma thinks that the market will go to the moon. Usually those times are a little bit dangerous, and we should be paying attention to that indicator. So if you're not yet a subscriber, consider signing up. But if you're a subscriber, I will be covering it in the members only. Dow Jones Industrial Average, same thing, new all-time highs. These are all-time highs. Dow Jones, it's an older kind of index where we use it still, but we have S&P, we have the NASDAQ, we have the small caps. Dow Jones is a little bit limited, and their selection is kind of sometimes strange. Nevertheless, if you subscribe to Dow Jones, to Dow Theory states that if Dow Jones Industrial Index goes to new records, or at least is moving up, then the transportation sector also should be moving up, in lockstep. And lo and behold, transportation sector, here's IYT transportation, has also hit an all-time high. There it is, all-time highs for transportation sector. So we have confirmation from the Dow Theory that indeed we're seeing new records, and they're not a fluke. They're not an artifact of large cap stocks pushing the stocks higher, while some of the smaller transportation sector stocks, such as railroads, are barely keeping up. So in this case, we're definitely not seeing that. We're seeing broad participation, which is a very good sign, I think, for the stock market. The rally is indeed currently driven strongly by technology. So here are semiconductors, again, just hit an all-time high. The gap on semiconductors is slightly bigger than I just showed you for S&P. So notice this gap is relatively large, and it is not even partial, it's an actual gap on the weekly chart. So is this an exhaustion gap? It's possible. I mean, we have traded this stock, or rather this sector, we can technically say industry group. This is semiconductors, and notice that the last alert, because there was really no other opportunities, was back in exactly a year ago. And since then, really, there was no pullback whatsoever. So now we're seeing new records, and if you are still open, and I hope you are, I hope you didn't close this position from May of last year, you're up 155%. How do you wrap your mind around 155%? Okay, so we bought at 230, and if we are to sell right now, we're at about 600. So we more than doubled. We've doubled and a half. Congratulations if you're still open. I would continue holding. I mean, you could considerably, conceivably take profits, but we don't know. I mean, look how strong this rally is. It just keeps going. So who knows? Maybe we'll continue even higher. Technology sector, XLK, pretty much the same setup as I just showed you with SMH semiconductors. The last opportunity to buy was back in May of 2025. Some of the stocks that are in this sector are Microsoft, Apple, and Nvidia, and all those three. Surprisingly, Nvidia is actually kind of smallish. I think it might be bigger by now, bigger share of this ETF. But just the Microsoft and Apple make up 50% of this ETF. So Microsoft is lagging a little bit, but Apple actually is also at record. So it makes sense. So technology, semiconductors are driving this market rally. However, I will show you in a few seconds that it is not just that. There are other sectors, stocks, and indices that are also driving this rally higher. NASDAQ, QQQ, the QQQ has very similar stocks. It's what's called tech heavy. So a lot of Apple, a lot of Nvidia, and all that. So yes, makes sense, semiconductors. It also makes sense that we're at records. I actually still have my position open. I bought it personally back in May of 2025. For some reason, I thought that back in September 2025 that was the top, so I sold half my position, kept the remainder. Now I realized where I was very premature. This is the type of trades that we do quite often. So yeah, you can use my indicators to day trade. You can use my indicators to do like scalps. You can use my indicators to do short-term trading, but by and large, you probably want to be doing longer-term trades, so swings. This is a swing trade. So my preference personally is for longer-term swing trading. So in other words, my system, when you simply buy on close above the blue support resistance line, and again, you can just get the same indicators for your chart. My system works very well for longer term accounts. It works just like one of my retirement accounts is just blockbuster. I don't think it ever lost money. And the only thing I'm doing is I'm basically following my own system, buying and close above the blue line, and just letting it ride. So again, if you're interested, find out more. Finally, I wanted to show that not only stocks are making all-time highs, but also high-yield bonds, junk debt. So very similar principle. You can see that last opportunity was back in April of last year, 2025, and again it just took off. So we would have been buying at around $86, and currently it's around $95, $96. But you have to remember that these are actually bonds, high-yield bonds. Although high-yield bonds or junk debt, they behave more like stocks, and they could be used sort of like a diversifier in a stock portfolio almost. But the returns for high-yield bonds are lower, and at the same time, the volatility is significantly lower. So there are some parameters such as beta, such as volatility, and for high-yield bonds, these are lower parameters. So if you are trying to diversify your stock portfolio to lower the volatility, high-yield bonds actually work quite well. Now, having said that, high-yield bonds just hit an all-time high, and what does that mean? Because we want to look at high-yield bonds not only in a vacuum, but also in the context of how does it correlate or doesn't to the S&P 500. And clearly it does correlate quite well. So down below here, the correlation coefficient for high-yield bonds and stocks is very high. So when high-yield bonds and stocks are doing the same thing, it makes me feel warm and fuzzy, because that means that this rally is not driven only by gains in stocks. There is also gains in high-yield bonds, and because of the correlations, we want that correlation to be high. We want the correlation to be high between stocks and bonds. If the correlation is suddenly low or negative, something is off. So we need to look under the hood and figure out what is wrong. But right this instant, there is really nothing wrong that I can find. Well, except if everything wrong with the world, but there is nothing wrong with this particular chart. And it's a good sign that we have a high degree of correlation between the stocks and the high-yield bonds. So good news. This is also sort of like a Dow Jones Dow theory, where you have Dow Jones Industrial Average must correlate greatly with the transportation sector. Now, in my mind, in the theory of Alexander from Master Charts Trading, when we have high-yield bonds making records or just moving together in lockstep with S&P 500, that is a confirmation of the bull market. In addition to my blue line, when we're above the blue line, that means we're in a bull market. So there is a gist of what I'm trying to say. So we have multiple correlation that this market is multiple confirmation rather that this market is very bullish and most likely will continue doing so. But obviously a pullback cannot be ruled out, because this cannot be ever ruled out. There's always a possibility of a pullback. There's always a possibility of something crazy happening. For example, when the Pearl Harbor was attacked, market was closed. They just closed the market for like, I don't know, a few months. And then later on, it opened with a gigantic gap. I believe it was a gap down. So yes, absolutely, that can happen. Hopefully that won't happen in our days, but you never know. Small caps. So small caps are extremely sensitive to the economy in the United States, and I mean, we can sometimes hear on the news all kinds of scary stories about small, firms struggling and going under. But looking at this chart, I can't tell that. I can see that small caps are at all-time highs. So same thing. We're seeing small caps at all-time highs with a gap up, possible exhaustion gap, but it could be also just a gap up because of the buying pressure. That's also a possibility. We don't know if this is an exhaustion gap. Some people claim that volume is important. If you can see that there's no volume on my charts. I tried using volume before, but honestly, it gives me very little edge. If anything, it confuses the signal. So I do not use volume. I only use my indicators, and whenever we see a close above the blue line, that's all I really needed to know. So there. So small caps also at all-time highs. Small caps, there are 2,000 stocks in this index, so vast majority of these stocks are making records. This is a very, very strong market. Finally, RSP. This is equal weight S&P 500. So let's say, we have S&P 500, and within it, we have Apple, Google, and Microsoft, and those probably make up like good 20% of the S&P 500 capitalization-based index. But in this case, RSP, ticker symbol RSP, equal weight. So every single stock within this index is equally weighted. So Apple is only like 0.3 or 0.5%. I don't remember exactly. So again, at all-time highs. This shows again broad participation, and I would basically at this point continue holding. There's really not much. I don't see a big reason to sell at this point yet. All right, so what I wanted to do was to highlight a recent trade for Ford. Okay, so Ford collapsed into a bear market here where it says avoid here. It collapsed into a bear market right there on August 2nd, 2024. And since then, how do I know? It closed below this yellow support resistance line. So at this point, we basically either do nothing, but if you're very sophisticated, you can actually sell short on any rebound. So like, for example, back here in 2024, you can see there's a rebound, touch of the red line, sell short right there. Rebound, sell short, rebound, sell short, etc., etc. So this actually worked quite well for a while, and then it stopped working. When? Right there. On July 2nd, 2025. Excuse me. How did I know? The only thing I need to know really is to see whether or not the price has closed above this blue support resistance line. Again, you can find out more about this by going in the description of the video. So we continue forward, and you can see that we came down, but our stop initially, so let's say we bought it back here in July of 2025, our initial stop would have been way down here at the yellow line. Our target would have been two average true ranges. Okay, so this is an indicator called ATR, average true range. So our stop would have been two average true ranges away from the entry. So for example, if back here we bought and average true range was, I'm reading it off the chart, it was like 20 cents. So our stop would have been about 40 cents, like right there. And would have reached it right there in September 2025 rather. But you know, it continued forward and actually made further highs, so I would have kept it open. Eventually, it stopped and we pulled back. Okay, so we pulled back towards this blue support resistance line, and basically we're armed. Okay, at this point we're armed, we're locked and loaded, we haven't yet pulled the trigger. Okay, later on, a few days later, right there, on 14th of April of this year, we pulled the trigger. In fact, I pulled the trigger. I bought it myself. I bought, Ford stock myself. And at first I was a little worried because notice it came down. It came down towards this red support resistance line, and I was worried that we're going to collapse and then close below the yellow line, and I would have been stopped out. Earnings came actually insanely better than expected. And the stock a few days later took off, but I think this taking off was on the news of Ford getting into the energy business. Frankly, I don't care. You know, we're looking at this chart from a point of view of vacuum. It could have been any other name here. It could have been Acura or some other name. It's just a chart, you see, and these are just lines that are calculated for a particular chart. There is no magic, it's just math. Okay, so we fulfill the math by buying at the trigger. Okay, so trigger occurred on 14th of April. I set in a position, a few days. Target was reached like right there on May 14th. I moved my stop to entry. So at this point, I cannot lose money unless it gaps. But that happens quite rarely, especially it happens rarely with largish stocks. It sometimes happens with like very, very small cap or speculative securities. But with larger cap stocks, it barely ever happens, like gigantic gap down, for example. I mean, it could still happen, but the chances of that are lower than for the larger cap stocks. So in this case, I wasn't really terribly worried, and I was just sitting in the position. We got a little bit of a pullback. Luckily, I wasn't stopped out because my stop was at about 1250, and we pulled back as low as 1270. So I came pretty close to being stopped out, and thank God I didn't, because look what happened then. We had a huge run. I mean, we had 1, 2, 3, 4, 5, 6, 7, 8 days in a row of just massive gains. So right now my position is up from $12 to about 17. So that's a very nice gain, about 40% in the plus. Hopefully some of my subscribers also bought. So if you haven't yet, consider going to www.MasterChartsTrading.com. It's a big name, but I have good technology. So I'm still holding. My stop is currently at the blue support resistance line. However, I'm considering taking some profits if or when we pull back and maybe close, like, or at least touch this green support resistance line. I don't know if you can see it. So I put the alert here right now. If we touch that line, I might take some profits. But for now, I mean, it just keeps going, so I'm just going to keep holding it, basically. Again, congrats to subscribers. If you're not yet a subscriber, consider signing up by going to MasterChartsTrading.com. Dollar, we're switching gears. We're looking at Forex universe currently. So dollar currency index. Not an easy chart, I tell you that much. So let's kind of go through it slowly so that you see what I'm getting at. So first of all, for trading Forex, there is slightly different rules. So as I just showed you, the trading for stocks, like normal stocks, we buy and close a blue line, on close above the blue line, we put our stop on at the yellow line. Okay, you with me so far? Now with Forex trading, there is really no bullish bias, so to speak. So because, you know, if we trade stocks, I express my bullish bias by giving it wider stop, by giving it bigger benefit of a doubt. Because the stop is at the yellow line and not at the red line. If I was trading this the same way as Forex, I would have put my stop at the red line, but I'm not. So if we're trading Forex or any kind of continuous security on an intraday chart, like for example 5 minutes, yeah, you can do this also. You can trade on 5 minutes. So for example, here's dollar currency index, and it's clearly in a downtrend on 5 minutes, so you sell it short every time it touches the red line from below. So you sell it short, and you would have been very much correct today, for example. Excuse me. So looking at this chart, we're looking at, first of all, dollar currency index was in a downtrend until right there where I'm hovering. On May 30th of this year, it broke out above the blue line and it became bullish. In fact, it was then pulled back and retested this red support resistance line. We came super close to again going into a bear market, but we didn't. We actually held on because we didn't close below that line. Notice that we again touched it on the 1st of May, but finally continued higher, had painted this weird looking triangle, broke out of it, and then finally closed again above the blue support resistance line. So in my mind, this reaffirms the bullish posture for the dollar. However, just yesterday, this candlestick just doesn't look that appetizing. It looks a little bit kind of like a rejection candle. So this is the reason why I'm kind of now again not 100% which way this thing will break. As of today, if they put a gun to my head, I said buy the dollar. But let's look at gold, and why do we care about gold? So here's gold on the daily time frame again. It's XAU divided by USD. So XAU divided by USD, meaning that if the bottom part of this equation, USD, is going to be getting bigger, and it's in a bull market, so it should be getting bigger, right? If it's going to get bigger, then it should kind of like pull this currency pair lower. In fact, right there on the 27th of May, I thought this was it. I thought we're gonna collapse now, and gold will go to, at least 4,000, maybe even lower. Yesterday and today, the action seems to have reversed, and actually gold seems to be again heading higher. So this is why I am not 100% about the way dollar is going to behave in the next few weeks. Nobody's actually 100%. Biggest clues are coming from GDX and gold miners. So, for example, on the 27th of May, dollar painted a green candlestick. On the 27th of May, gold miners painted a red candlestick. That makes sense. That makes a lot of sense. Before that, on 26th of May, gold painted a bearish red candlesticks. Yet gold miners actually gapped higher. So this is where I was kind of confused on the 26th of May. That why would this happen? Why would gold, or rather, yeah, why would gold be, or rather, why would dollar be? I'm sorry. On the 26th of May, right there, gold moved lower. Gold miners moved higher, right there, 26th of May. So why would this happen? And I was really confused. So now I am like wondering if gold miners know something that gold doesn't. And so I am less reluctant to sell miners or gold and potentially just wait until finally dollar clarifies which way it's going to go. Because if it goes down, then obviously gold and gold miners will just skyrocket. So right now, again, somewhat unsettling, somewhat unsettled situation, but I think it might resolve itself relatively soon once the dollar either like just makes a finally like a significantly higher high, you know, maybe around 100, or at least moves higher, or it will break down. So all eyes are on the dollar. Finally, let's wrap up with crude oil. And crude oil is currently in an uptrend. You notice all of these up arrows. Last one obviously didn't work so far, and I was, you know, I don't think these are not actual alerts because you can see they're purple. My actual alerts are always in light blue, like this, or white, when I actually send them out or take positions myself. So see, so crude oil currently is in an uptrend, technically speaking, or in other words, the bullish bias. I want to be thinking about buying, but the way it's been acting over the past 1, 2, 3, 4, 5, 6, 7 sessions is clearly not that bullish. In fact, notice that we're actually dropped below the previous low from 6th of May. So if we continue lower towards this red support resistance line, which is currently around $79, and you know, usually see how over here, for example, on the 17th of April, we came down exactly there, we touched it, and then rallied. So I think a retest of that level of $79 for crude oil is coming relatively soon, probably next week. And most likely this is going to be the catalyst, or the catalyst for this drop would be some sort of a peace process deal in the Persian Gulf. Knock on wood. It will finally at least resolve. So, you know, world is very dangerous right now. More dangerous than I can remember in my, you know, over 50 years of life. I don't remember, obviously, when I was a child, but back in the good old Soviet Union where I was from, everything was just like black and white, you know, and now things are not necessarily black and white, they're sort of gray, and not necessarily even gray, there's just sometimes weird pattern colors. So it's difficult to say who is the good guy, who is the bad guy anymore, if that makes any sense. Anyways, make a comment below, let me know what you think. Otherwise, head over to MasterChartsTrading.com. MasterChartsTrading.com is my site. If you are interested in signing up for the indicators, these green, blue, red, and yellow lines are currently available for this interface, TradingView.com. TradingView.com is a free interface. You need to just sign up for free on TradingView.com. Come back to my site, Master Charts Trading. Click on sign up for one of the products. So trading indicators and newsletters are the ones that contain this particular product. If you don't need the indicators, you just want what I am sending out as alerts, as in, for example, Ford. That was a nice alert for good for 40% move in just a few weeks. Then just sign up for the newsletters. And of course, the best deal is to get both trading indicators and newsletters. And the best deal of the two that I have are either monthly or yearly. Yearly deal is obviously better. If you get a yearly deal, you get 2 months free, 17% off at $49.95 equivalent per month versus $59.95 equivalent monthly for the monthly plan. All right, that's it for this week's recap. Again, don't forget to hit the like button, share this video, make a comment, put a thumbs up in the comment section. This would keeps the channel going and makes this video more interesting to the algorithm of YouTube. Thank you for watching. Have another great trading week. Bye-bye.